Welcome to today's market report.
A rout in global equities extended on Friday, and government bond markets came under fresh selling pressure as hawkish tone from central bankers and week later stoked recession fears. The selling spilled over into commodities markets where oil prices dropped over $2 per barrel. Gold prices faced their biggest weekly loss in 4 weeks after the Federal Reserve indicated it was not done hiking rates. The dollar rose in chopping trading, while the Fed was one of a slew of central banks that jacked up interest rates and signaled that the fight to tame inflation this week. Eurozone bond yields jumped a day after the European Central Bank pledged further monetary tightening to fight inflation. US yields also rose, catching up with the gold bond sell-off. The data confirmed Wall Street's fears that the economy is quickly headed towards a recession. The Dow Jones fell 0.85%, the S&P lost 1.11%, the Nasdaq dropped 0.97%. European shares posted their largest weekly loss since September, with the STOXX 600 index ending down 1.2%, skidding to a weekly loss of nearly 3.3%. The dollar index edged 0.23% higher, while the euro was down 0.3%. This week's hawkish message from central bankers brought an abrupt end to optimism that peak interest rates are on the horizon. The ECB delivered a 50 basis points hike like the Fed. Both opted for a smaller increase this time, but flagged there were more increases to come. This hawkish message prompted a second day of heavy selling across European bond markets, where yields on benchmark German 10-year bonds jumped. We now expect the ECB to go to 3.25% and the Fed to go to 5.25%, which argues for persistent pressure on yields and the spreads.
This is today's market news. Thanks for listening. We'll see you next time.